Hello, everyone, and welcome to Unit 2 of our education series on Stock Investing 101. We're thrilled to have you here with us today as we take one step closer to investment learning. In this series, our intent is to help you understand the investing basics and provide you with the knowledge to make better decisions on stock investment. Today's lesson has three objectives. First, what is investing? Second, who are investors? And the third is 5 common traits of successful investors. So, without any further ado, let's get started with what is investing? Investing is the act of allocating resources, usually money, with the expectation of generating a return or profit in the future. In the context of stock investing, it means buying stocks of companies with the expectation of making a profit. The goal of investing is to grow your wealth over time by putting your money to work for you. We can understand this more with the help of an example. Imagine you bought a house and rented it for $3,000. It means from now onwards, your house will work for you and put money in your pocket. This is what investors do. They buy the assets, and the assets work for them. Let's talk more about investors. When we hear the word investor, we always think of the movies where people wear fancy suits and talk about billions, which is so untrue in real life. Anyone with even a small amount of money can become an investor. Investors are individuals or institutions who allocate their resources, usually money, with the expectation of generating a return in the future. There are many types of investors, including individual investors and institutional investors such as mutual funds. Let me break down the definition. Investors can be individuals or organizations. Who invests the capital in purchasing assets? With a defined level of risk and calculated returns. Over a time frame with a specific financial goal. Remember that the principles of successful investing are simple, but the hard part is sticking to them through the ups and downs of the market. All successful investors have some common traits, which help them follow the principles. Let's discuss about the 5 common traits of successful investors. The first one is long-term thinking and patience. Warren Buffett always says, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. Investing is often referred to as a game of patience because it involves making decisions that will have long-term effects on your financial situation. The market can be unpredictable, and prices can fluctuate widely in the short term, so it's essential to take a long-term approach to investing. There are many reasons why long-term thinking can be beneficial, including the potential for compounding returns over time, the ability to ride out short-term market corrections, and the potential to benefit from the growth of high-quality companies. Second is, invest in good businesses. A good business is one that is profitable, sustainable, and ethical. Understanding the business can help you measure the investment potential. Warren Buffett has often used the analogy of buying stocks to a farm, where investing in a good company is like purchasing a productive farm that can consistently produce crops year after year. He has emphasized that the objective should be the output it produces over the long term, rather than constantly estimating the land price every day. This means that investors should focus on the value created by businesses, instead of short-term price changes in the stock market. Third is, don't follow the herd. Be fearful when others are greedy, and be greedy when others are fearful. Good investors do not panic or rush to profit from momentum-based trends. They have a system that they believe in, and they understand when to buy and sell. Instead of being influenced by market trends or emotions, they focus on making rational and informed decisions based on their knowledge and research. Fourth is, diversifying the investment. The consensus among famous investors is that diversification is an essential part of a well-managed investment portfolio. It means good investors do not put all their eggs in one basket. By diversifying their investment across multiple companies and sectors, they can spread their risk and reduce the impact of market fluctuations on their portfolio. Fifth is, understand the risks involved. Warren Buffett always quoted, Rule number 1, never lose money. Rule number 2. Never forget rule number 1. We can't deny that risk is a critical part of every investment. When the time comes to make a decision, good investors are rational and act based on financial numbers. They know the difference between speculation and investment. As an investor, you should understand how much risk you are willing to take. In this lesson, we covered these three objectives. Firstly, we discussed the meaning of investing and how money works for you. Secondly, we explored who are investors. Thirdly, we outlined the common traits shared by successful investors. I hope this lesson has provided you with a better understanding of investing basics and some secrets of successful investors. So, there you have it, folks. We hope that you enjoyed this lesson and learned something new. Thank you for watching, and don't forget to subscribe to our channel for more exciting investment content.